All right, my friends, well, the new month is officially upon us, and what better way to kick it off than with a dividend portfolio update? Today, we're getting all caught up to speed, and I'll show you everything like my best and worst performing stocks for the month, all of my recent moves in the portfolio, and we'll discuss what my upcoming plans are here in March. But before we get to that, guys, I want to hear from you. Leave me a comment below and let me know what's been going on in your portfolio this last month. Were you up? Were you down? Did you make any crazy buys or have any crazy huge dividend payments coming in? Maybe you hit some new milestones or something like that. I don't know, but anything cool that happened to you guys in this last month, I want to hear about it in the comments below. Anyway, guys, getting into how my portfolio performed this last month over here on my dividend portfolio tracking spreadsheet, which you can start using for free. There is a link to download this spreadsheet in the description of the video. But starting here with my main taxable brokerage account, we can see that this is currently valued at just over $57,000, which is yet again another all-time high in this account, guys. I actually think this is the fourth month in a row that we've seen an all-time high in the portfolio, which is both a good and a concerning thing. It's good, obviously, because it means that we're making money, but at the same time, it puts me a little bit on edge because for these last few months, it just feels to me like these gains have come way too quickly and just far too easy. If we go back to the start of November, this account was valued at about $46,000, and overall it was down in the red by about 4.3%. So across the entire portfolio, I was seeing a loss. And since then, it's obviously climbed considerably higher than that, which is nice, but all of this happened in a relatively short amount of time. And once again, don't get me wrong, I'm certainly not complaining that my stocks are doing well. It's just that I wouldn't be surprised if at some point the market suddenly switches and I see a lot of these gains evaporate because, you know, easy come, easy go. In which case, though, that would be fine too, because we'd be able to get more bang for our buck since stocks would then become cheaper to buy. But anyway, guys, we'll see what happens. And then moving on, looking at my gain just in the month of February, in total, I jumped up about $1,200. So a pretty sweet climb just in the last 28 days. And looking at the breakdown, it was an overall really good month for me, both in terms of share price gains, where I was up about $970 there, and also in terms of dividend income, it was actually a record month of income, and in total, I brought in about $241, with my largest payment coming from EPD, Enterprise Products Partners, who paid me $51.93. Now, if you want to see the full breakdown and see all of my dividend payments from this last month, and check out the video linked in the pinned comment. I go through all of the payments there. Anyway, guys, this month's gain leaves me with a rate of return of about 2.2% in the month of February, which is not too shabby, but I did underperform the three major indices here. It looks like the S&P was up 4.8%. The Dow just barely beat me. It was up 2.3%, and the NASDAQ saw a gain of about 3.4%. Now, with that, on a year-to-date basis, it looks like I'm up 2.2% and still am underperforming the three major indices in this time period as well. And then in the last 1 year period, my portfolio is up 13.4%, so pretty solid gain, but still, yet again, guys, I am underperforming the S&P, underperforming the Dow, and underperforming the NASDAQ. But having said that, as we can see, I am outperforming SCHD across all of these time periods. Just in the last month, SCHD is only up 0.6%. Year to date, SCHD is up 1.85%. And in the last year, SCHD is up 7.4%. So I've nearly doubled the returns of the holy grail of dividend ETFs. With that said, though, I do think it's important to keep in mind that whatever happens in a short 1 year time frame really doesn't matter that much in the grand scheme of things. And as Terry Smith says, a year is just the time it takes the Earth to go around the sun. It is not a natural time period over which to measure the performance of any business or investment unless it is linked to the Earth's orbit. To assess an investment strategy or fund, you need to see its results across a full economic cycle with both bull and bear markets. So we'll see how all of this plays out across a longer time frame, but I'm not going to stress too much if there are certain periods where I underperform the market, because across a longer period of time, across a multi-decade investment journey, it's bound to happen at certain points. It's bound to happen intermittently, just depending on what type of market environment we're in. And the thing about investing that's important to keep in mind as you go through this is that investing is an infinite game that never ends. This is something you're probably going to be doing for the rest of your life, and an investor may possibly underperform the market for a year, or for 3 years, or for 5 years in a row, none of which are long periods of time as it pertains to investing, by the way, but this is especially important to keep in mind if in that time period we've really only seen one side of a two-sided market. It's also important to keep in mind too that some investors have more defensive portfolios. I think a lot of us dividend investors do. And we may underperform when times are good and the market is booming, but because of that, it's also possible that we'll see much less of a drawdown when times are bad and when the market really heads south, which can ultimately lead to better performance over the long haul. I think my portfolio tends to be a bit more on the defensive side, and so if and when we do see the market really head south in a big way, it'll be interesting to see how my portfolio performs in that type of market environment. And if it's anything like what we saw in 2022 a couple of years ago, then I feel pretty good about how things will end up. Anyway, guys, switching gears and taking a look now at my best and worst performing stocks for the month. No surprise, my best performing stock in the last month was Williams-Sonoma, who saw another just pretty crazy gain, guys. In the last 30 days or so, they were up a whopping 17%. Just an incredible climb, which leaves them with a year-to-date gain of about 15, almost 16%. So all of their gains and then some this year have come just in the last month. And as I'm sure you can imagine, this leaves my position just in an incredible spot, guys. Okay, in terms of share price, I'm up 75.3%. On a total return basis, I'm up 76.8%. So this is by far my best performing stock out of every single one in my portfolio. It's seeing the highest gain in terms of percentages and also in terms of dollars. This one is just on fire. And then, guys, another one that's done really well for me lately is Lowe's. Just in the last month, Lowe's is up 13.2%, which leaves them with a year-to-date gain of about 8%. So once again, all of their gains so far this year and then some have come just in the month of February. And this leaves my position in a really great spot right now. With Lowe's, I'm up 23.4% in terms of share price, but including dividends on a total return basis, I'm up about 26.75%. And then we've got big bad AbbVie, who's also seen another pretty nice gain in the last month, guys. They're up 7.3% in the last 30 days, which brings them to a year-to-date gain of almost 14%. So AbbVie's off to a great start in 2024. And looking at my position, this is another one of my best performing positions. Just in terms of share price, I'm up about 54.5%, but the dividends give me a nice little boost, guys, about a 13% boost actually. And on a total return basis, I'm up closer to 68%. So all three of those did pretty well for me this last month. And then on the other hand, in terms of poor performing stocks, there were only two in particular, both real estate investment trusts, who saw pretty big drops in the month of February. With the first one being WP Carey, who was down over 10% just in the last 30 days. And we can see that they really dropped off a cliff right about here after reporting their quarterly earnings, where they delivered a miss on both revenue and FFO for the quarter, while also narrowing their guidance for the full year. And with that drop, WP Carey is my worst performing position right now, but it's really not too bad. It actually looks worse than it is. I'm down 14% in terms of share price. On a total return basis, I'm only down 4%, but in terms of dollars, just looking at the total return, I'm only down like $100. So that's really not like a life-crushing amount. I think I'll survive. And then Realty Income was my second worst performer in February, guys. They were down 5.75% in the last month, and then looking at the performance so far this year, they're down about 9.25%. And with this drop in the last month, guys, I am in the red with Realty Income, but it's really not too bad. I'm only down 4.4% in terms of share price, but dividends put me back in the green, and on a total return basis, I'm up 2.4%. And now moving on and getting into all of my buys and sells for the month. I did make a couple sells in February, guys, and I've talked about this in a couple of videos already, but I ended up selling out of both AT&T and Verizon, and I took a loss on both of them, as we can see here. But with the funds from that, I was able to go on an incredible shopping spree, and overall February ended up being a really solid month of buying. As you can see here, the first stock I added to in February was Chevron, and I haven't added anything to Chevron for a long time, but I figured I might as well. I picked up 6 shares at an average cost per share of $153.22. And then I also added to the other energy stock in my portfolio, EPD. I picked up 12 shares of EPD at an average cost per share of just over $27. And then third here, Main Street Capital Corporation, which is another one I haven't added to for a long time. I think it's been over a year, but I ended up buying 17 shares of Main Street Capital Corporation at an average cost per share of $44.78. And then the big kahuna, guys. I loaded up on Realty Income. As you know, I've talked about this in a couple of different videos already, so I apologize if you've heard this before, but I ended up buying 29 shares of Realty Income at an average cost of just below $52 per share, which officially leaves me with now over 100 shares of Realty Income. So a cool little milestone there. I was happy to hit that. But anyway, guys, the next stock that I added more to was Starbucks. And I've pretty much just been buying a share of Starbucks every single week for the last couple of months now. And in February, I added 5 shares at an average cost per share of $94.51 and hit my goal of reaching 50 shares of Starbucks. And I might keep going from here. I might continue to add to it. We'll see what happens. But I do have bigger fish to fry, namely this next stock here that I've been adding to, as you guys know, Visa. I've been buying 1 share of Visa every single week, seeing as this is my newest position. But in February, I picked up 5 shares at an average cost per share of $277.95, which now leaves me with 12 shares of Visa. It's starting to get up there. I think this is the 6th or 7th largest position in my portfolio now, and I want to try and double my position from here and get it to be my top dog. And those were all of the stocks that I bought in my taxable account, but then with my Roth IRA, I made my weekly buys of SCHD and VU, and with SCHD, I picked up almost 5 shares in February at an average cost per share of $76.94, and then with VU, I picked up a third of a share at an average cost of $468.43. And with that, guys, now moving on and taking a closer look at my Roth IRA. At the time of recording, at the end of February here, it is valued at $7,948.08. So I saw a nice little jump here in the last month. It looks like we ended February at about $7,300, so a jump of about $600 there, most of which came from just my own contributions. But according to this, I saw a money-weighted rate of return of 1.66% in the last 30 days. And if we zoom out looking at the year-to-date performance so far, my Roth IRA is up about 4%. So doing pretty good there. And if we zoom out looking at the performance all time, I'm up 24% with the Roth IRA. And you can see, guys, it's really started taking off here, okay? At the end of October, it's just soared. And with that, if we take my main taxable brokerage account, currently valued at $57,000 and is generating about $2,350 of annual dividend income, and add that to this $7,948 Roth IRA that is now officially generating over $200 of annual dividend income, that's going to bring the combined total of these two accounts to $64,975, and in total I am generating $2,553 of annual dividend income every single year, which is a gain of about $24 compared to this time last month where my projected annual income was $2,529. So a little bit of a jump there. It would have been higher if I didn't sell out of AT&T and Verizon, but sometimes you have to take one step back to take 2 steps forward. But anyway, this is going to bring my year-to-date income gain to about $80. I started off 2024 at $2,473, so we've seen a nice little jump so far. Now, as far as my watch list goes, once again, there were no new changes in the last month. It's been some time since I've added any new stocks to the watch list. So for now, Rollins is the only one that I really have my eye on, and that's just a waiting game at this point. I'd still like to see a lower share price before I jump into that one. And with that said, I'm in absolutely no rush to add another position to the portfolio right now. I feel really good about where things are at, especially now that I've sold out of AT&T and Verizon. And for now, I'm just focused on building out my Visa position even more. Like I said earlier, I'd like to double my position from here and get it up to maybe 24, 25 shares in total. I may add a bit more to Starbucks along the way as well, but those are really my only big plans moving forward. And outside of that, guys, I've been doing a lot of reading lately. I started and finished Same as Ever by Morgan Housel last month, which I highly recommend. Really good book. And now I'm in the middle of Investing for Growth by Terry Smith, which I referenced earlier in the video. And I'm really enjoying that so far. I'm learning a lot from that book. But anyway, I'm logging all of my book notes in my Dividend database. I've been getting a lot of use out of that, and it is so close to being ready to share with you guys. I'm so excited. I'm going to be releasing the database template in the next couple of months, so definitely stay tuned for that. I think you guys are going to get a lot of use out of this tool, and I think it's something that you'll be able to use for a long, long time. But having said that, I think I might want to come up with a new name for this Dividend database. The more I think about it, the more I think that the name Dividend database is a bit limiting, since there's so much more that goes on using this tool than just dividend stock. So if you guys have any ideas, if you have any suggestions, let me know in the comments below. But anyway, guys, that's what I've got cooking up for the month of March. And in this next video right over here, I'm telling you about 3 deeply discounted dividend stocks, all of which look like great pickups right now in the month of March. So click right over here to learn all about those, and I'll see you in the next one.